Hello. Let's talk about life insurance. So, what is life insurance?
Life is often uncertain and unpredictable. Hence, it is necessary to ensure you and your family are protected from these unpredictable and inevitable life events. Whether it's planning for retirement or protecting your loved ones in your absence, life insurance is a necessary protection plan. Life insurance is a contract between a policyholder and an insurance company that's designed to pay out a death benefit when the insured person passes away, or pays out a lump sum payment if the insured person experiences total permanent disability, which refer to someone is not able to work for income due illness or injury. Life insurance is a very common asset that figures into many people's long-term financial planning. Purchasing a life insurance policy is a way to protect your loved ones, providing them with the financial support they may need after you die.
What is important for this life insurance?
Firstly, is to protect for you and your family. If you are the primary breadwinner, then life insurance is a must. Life insurance protect your spouse or partner, your children or your aged parents or other dependents, if you are no longer around, because it replaces your income when you die. In addition to providing income to cover everyday living expenses, your family needs insurance to cover any outstanding debts, like the mortgage, credit cards and car loans. In the event of your death, your loved ones will have to pay your funeral expenses and pay off any financial liabilities you have, such as your debts. There are a variety of ways to prepare for retirement. However, life insurance is one of the ways to prepare for retirement. With a life insurance plan, you can ensure you have a regular stream of income every month. Putting money in an annuity is like a pension plan. Put in some money regularly in a life insurance product and enjoy a steady income every month even after retirement.
Now we talk about life insurance coverage.
Life insurance coverage is designed to provide a measure of financial security for your loved ones if you pass away. These policies allow you to name a primary beneficiary and one or more contingent beneficiaries to receive a death benefit should you pass away. The two basic types of life insurance are term life insurance and permanent life insurance.
What is term life insurance?
Firstly, term insurance is a kind of life insurance that can provide coverage within a certain time frame, and the premium remains unchanged during the validity period of the policy. Typical choices are 10, 15, 20, 25 or 30 years policy term. If the insured person dies within the time period specified in the policy, and the policy is in force or active, the beneficiary of the insured person is entitled to the insurance money. After the policy period expires, the insured can renew the insurance in 1-year increments, which is guaranteed renewability. Let's talk about permanent life insurance. Permanent life insurance can cover you with insurance, which can be effectively transformed into lifetime coverage. It is more expensive than term life insurance because permanent life insurance can last a lifetime, and it allows you to gradually accumulate cash value, and if necessary, you can borrow cash. Here, as long as you are alive, as long as your payment is always valid, life insurance will always be with you. Whether you are a relative or a designated charity, whenever you pass away, no matter where you are, your beneficiaries will receive a sum of money.
There are two main categories in permanent life insurance. Who know?
Whole life insurance and universal life insurance. Whole life insurance provides a fixed amount of death compensation and cash value, and grows with a guaranteed rate of return. Many whole life insurance policies pay dividends. Over time, these policies generate considerable cash value, which is guaranteed and can be used at any time. Regardless of the economic situation, the annual increase in cash value is guaranteed. Universal life insurance provides more flexibility than whole life insurance policies. You may be able to change your insurance and death benefits. The structure of a universal life insurance policy can pay cash value other than the face value, but in this case, life coverage is usually not guaranteed. When purchasing life insurance, it's important to understand how it works and how your beneficiaries can receive the proceeds of your policy. This can help with choosing a payouts option that works best for your estate planning goals. As part of the process when buying life insurance, you'll need to designate one or more beneficiaries. This is who you want to receive the death benefit from your policy when you pass away. A life insurance beneficiary can be a spouse, parent, sibling, adult child, business partner, charitable organization, a trust. 2. Need to filling a claim. Death benefits are not paid out automatically from a life insurance policy. The beneficiary must first file a claim with the life insurance company. Depending on the insurance company's policies, this may be done online or it may require a paper claims filing. No matter how you end up filing, the company normally requires paperwork and supporting evidence to process the claim and payouts. Your beneficiaries may be required to provide a copy of the policy, along with the claims form. They must also submit a certified copy of the death certificate, either through the county or municipality or through the hospital or nursing home in which the insured died.
When? Benefits paid.
Life insurance benefits are typically paid when the insured party dies. Beneficiaries file a death claim with the insurance company by submitting a certified copy of the death certificate. Many states allow insurers 30 days to review the claim, after which they can pay it out, deny it, or ask for additional information. If a company denies your claim, it generally provides a reason why. Most insurance companies pay within 30 to 60 days of the date of the claim. There is no set time frame, but insurance companies are motivated to pay as soon as possible after receiving bona fide proof of death, to avoid steep interest charges for delaying payment of claims. There are several possible situations that may result in a delay in payment. Beneficiaries may face delays of 6 to 12 months if the insured dies within the first 2 years of the issuance of the policy. The reason is the 1 to 2 year contestability clause. As long as the insurance company cannot prove the insured lied on the application, the benefit will normally be paid. You can also help decide how your death benefit will be paid out after you die. Here are a few of the payout choices available to you and your beneficiaries. First, lump sum payments. Second, installments and annuities. Third, retained asset account. Life insurance policies provide both policyholders and their loved ones peace of mind that financial difficulties may be avoided in the event of a person's death. Understanding how the process works, from buying life insurance to filing a claim to receiving a payouts, can help you proceed with your plans to purchase coverage confidently. Life insurance is not for everyone, but certain people and certain circumstances make life insurance a smart idea. If a person is in danger or suffers economic loss as a result of death, life insurance is required.
Who should have life insurance?
First, it is highly recommended that parents with children purchase life insurance to take care of the needs of their children and spouses before a child is born. A young couple who works normally may not need life insurance. However, when the first child appears, there must be adequate insurance so that each child can meet the appropriate financial conditions. Second, the business owner, main employee or partner is in debt. Without life insurance to pay off corporate debt, the owner's heirs may find it difficult to maintain the company's operations or be forced to sell. Companies typically insure the lives of key employees, as the loss of these employees can have a serious impact on the business. Life insurance is also commonly used to finance a sale agreement, which stipulates that the deceased's estate will be sold, and the surviving spouse will buy the deceased's interest in the company. This is especially important for minority shareholders who are unable to purchase the shares of a deceased major shareholder. Third, working couples approaching retirement age do not provide adequate funds for their retirement plans. This is if the surviving spouse relies on the spouse's salary to pay for a pension plan for several years. Life insurance can make up for the difference. Fourth, it is recommended that business owners and those who want to forget their financial legacy buy. They have a lot of assets that are not easily liquidated. This may be the case for farms or pastures, where almost 100% of the property value belongs to strictly controlled farms. In order for a person to inherit land or a business to an heir, there must be sufficient life insurance to pay tax.
Which individuals not advised to buy life insurance?
There are 3 reasons to avoid a life policy. Many insurance salespeople would prefer you not know. Not everyone needs it. Those who most need it are often least able to afford it. It might not a good investment because life insurance isn't necessary for everyone. Firstly, if you're a single person with no dependents, you probably don't need life insurance, at least not yet. Financial experts recommend life insurance particularly for people who financially support either a spouse, children, or other relatives. That means people other than themselves rely on their income to live. That's not to say buying life insurance is a bad idea if you are single and have no dependents to be your designated beneficiary. Whoever it may be, will still get a cash payout. However, there may be a better use for the money you would use to pay the premiums. Secondly, the retirees and pre-retirees. Life insurance premiums tend to increase prohibitively with age. As health declines, a person's life becomes more expensive to insure, so buying a policy later in life is not cost-effective. If you have heirs, make sure they are taken care of financially in your absence than buying a last-minute life insurance policy, such as a trust or naming them as the beneficiary on your retirement account. Thirdly, kids and college students. This may go without saying, but as a reminder, children and college students don't need their own life insurance policy. The only exception is for a child who supports their family, like a child actor. In that case, it's possible to purchase a policy for the child, although the adult is still the policyholder. In general, kids and young adults are most frequently the parties being protected by a parent, grandparent, or other guardian's life insurance policy. Despite youth being on their side, there's no real benefit to buying life insurance as a college student with no financial obligations. It's widely understood that life insurance is an important asset to have at one's disposal, whether it's for protection against the uncertain or planning for the future. Let's look at some real-life stories that show how people have benefited from life insurance. Travis Guthman? A business owner in the small town. Travis had been working with his insurance advisor Tom Bader for years, and had come to trust Bader's insight of his basic life insurance plan. Travis took Bader's suggestion when Bader advised him to add disability coverage onto their insurance portfolio. Just 2 years later, Travis was involved in a serious automobile accident, causing life-threatening injuries that required a multi-week stint in an intensive care unit. As the owner of a restaurant, Travis feared that his business, and thus his family's financial stability, would be in jeopardy. With the supplemental disability insurance in effect, though, Travis's income was replaced and their restaurant stayed in business. The Travis also were able to stay current on Travis's cumbersome medical bills. In the end, a routine policy check from their insurance advisor became perhaps the best decision the Travis ever made. Next we talk about Jim and Clara Bix. Jim Bix was a young, recently married electronics technician when the unthinkable happened. He was diagnosed with incurable lung disease. As his health began to deteriorate from the illness, Jim needed to turn to disability insurance to pay for the daily living expenses of his wife Clara and 2 daughters. Clara would need surgery to remove a cancerous kidney tumor. After her successful operation and a brief spell of happiness for the family, Jim succumbed to his illness. But, while the family may have fallen on hard times, smart decisions made by Jim helped keep the family afloat through these difficult circumstances. Jim had paid extra to double his coverage amount, and as a result, despite his untimely demise, the Bixes were able to enjoy the same lifestyle they had before his passing. It's common sense that most things in life can't possibly be planned for. That's why life insurance has proven to be a valuable instrument for families who want to plan for what could potentially be life's biggest expenses. As all these story illustrates, losing a loved one is always difficult, but it can be easier financially if you take the right steps for your family.